Good morning, everyone. Good morning, everyone. Okay, so we're into the last session of this topic, business valuation. Uh, we have like completed quite a few questions on business valuation into various aspects. Like we have done the cash flow based approach. We have also looked at the asset based approach, which will involve like calculating the net asset or a book value basis, NRV basis, replacement value basis, uh, income-based approach, which involve use of multipliers like the PE ratio or capitalization of earnings. Then we started with the cash flow-based approach, wherein we were trying to calculate the free cash flow for the firm, and we were simply taking the present value of all of them. Then we also looked at the levered or unlevered or equity beta and asset beta of the companies, right? Because we cannot use other companies' beta for us, so we need to adjust it according to the asset and the leverage that we have in the business. So we also said that this is something which we use as a proxy for our business valuation. So that's a proxy beta. After that, we started with quite a few questions, and I think we have completed up to question number 8, maybe, right? And then we have got ourselves introduced to economic value added, right? So let's just talk about a bit more into this economic value added, and then proceed with the questions based on this EVA. Okay, so as I've discussed in the previous class, economic value added, that's simply looking at what uh, profit or what sort of return has been generated by the company for its stakeholders, for its investors, and what return was actually expected from them. So, for example, in a company, there is an invested capital of 1,000 crores. And as a general investor of this company, we expected the company to be generating a return of 12% on us, which is a weighted average cost of capital. So basically, weighted average cost of capital is indicating um, the rate of return which an investor would expect from the company in general, or what's the rate of return that company is going to generate for all its shareholders. So we were expecting, as an investor into the company, that company is going to generate a return of 12%. So 120 was the return which the company was supposed to be generated in INR terms. Right. So on 1,000 crores, 12% was the return that was expected, which is nothing but the weighted average cost of capital. But when we look at the actual return which the company has generated by simply looking at EBIT into 1 minus T, or post-tax EBIT, this is also called as net operating profit after tax. Okay. Remember, this is also called as net operating profit after tax. So after tax, let's say the company has generated a return of let's say 200 was the EBIT. So if you make it a post-tax figure, that works out to be 40, right? So this economic value added is nothing but the difference between these two. So as an investor, we expected the company to be generating a return of 120, but the company has given us a post-tax return of 140. So there is a clear-cut case of, better performance by the company, which is better addition by the company into its value. So economic value added, the value addition which the company has undertaken, is this 20 crores. And therefore, we stated that economic value added is simply going to be calculated as EBIT 1 minus T, which is the post-tax EBIT, or we call it as net operating profit after tax. And from that, you're going to subtract whatever is the expected return from the company's capital, which is invested capital into WACC, invested capital into weighted average cost of capital, right? So that was 20. Okay. So that's how we calculated the economic value added. Now let's just try to do a few questions to enhance our understanding about this concept. So let's start with question number 9, guys, in the assignment sheet. Question number 9. With the help of following information from Jatayu Limited. Compute the economic value added. Okay, so we have to compute a clear-cut case of EVA given to us. So capital structure, we have like equity capital of 160 lakhs, reserves and surplus of 140 lakhs, debentures of 400 lakhs, cost of equity is given as 14%, financial leverage is 1.5 times, and income tax rate is 30%. Okay, so in this case, there is an interest expenditure which is applicable, which is of course 10% of the 400 lakhs. It's 10% of 400 lakhs, which is 40. Now the question has given us financial leverage, right? Financial leverage. So do we know the formula for financial leverage? Can you recall? Can you recall the concept of financial leverage from CA Inter? Yeah. Can you recall the formula for financial leverage? What is the formula for financial leverage? Not the percentage increase for the formula. We are talking of the formula which involved a shortcut sort of thing. Can I say it was EBIT, earnings before interest and tax, upon profit before tax, right? And we know this can be simply stated as earnings before interest and tax upon EBIT minus interest, right? So financial leverage is given to us in the question is 1.5 times, right? So this is 1.5 is equal to EBIT is something that's not given to us. So let me write it as EBIT upon EBIT minus 40. So if you're just going to solve it, like it will be 1.5 EBIT minus 60 is equal to EBIT, right? Because we just multiply this 1.5 with the denominator. So 1.5 into EBIT minus 40 into 1.5 is 60, that's equal to EBIT. And then we will say it's 0.5 EBIT is equal to 60. Right, guys? So 0.5 EBIT is equal to 60. Then finally we can say that our EBIT is 60 divided by 0.5. So EBIT works out to be, that's earnings before interest and tax, is 120. Right? So earnings before so earnings before interest and tax is 120. Now to compute the EVA, we know we require the post-tax EBIT. So compute EVA, we need post-tax EBIT, which is EBIT into 1 minus T, or what we call it as the net operating profit after tax. Right? So we say net operating profit after tax is nothing but EBIT into 1 minus tax. So EBIT into 1 minus tax rate, that simply means 120 into the tax rate is 30%. So 120 into 1 minus 0.3. That will give us like 120 into 0.7, which is 84 lakhs. So our net operating profit after tax is 84 lakhs. And finally, we need to also get the EBA. To get the EBA, we need the weighted average cost of capital. So let's try to get the weighted average cost of capital. So the weight of debt into cost of debt plus weight of equity into cost of equity. Right? So now, regarding the weights, let's just write down the capital structure here. Capital structure, we have like equity share capital, we have the reserves, and we have the debt. The equity share capital is 160. The reserves and surplus is 140. Debentures is 400. So if you look at the total equity, is 160 plus 140 is nothing but 300, right? So if you look at weightage of equity out of total 700, this is 300. So weightage of equity will be 3 out of 7. And weightage of debt will be 4 out of 7. Right? So we can calculate the weightage as 3 by 7 into cost of debt. Now, to get the cost of debt, we have the rate of interest as 10%, but we can make it a after-tax figure by simply taking it as 10% into 1 minus 0.3 plus 4 by 7 into cost of equity. What's the cost of equity given to us? 14% into 14%. So if you just apply the WACC, calculate the WACC, that's going to be 3 by 7 into 10% into 0.7 plus 4 by 7 into 14%. So that's like 11%. It's weighted average cost of capital. Got to be 11%. Is it 11 or another number? Well, I use the wrong dates. Yeah, this will be 4 by 7 and this will be 3 by 7. Right? Because we are using for debt, it is 4 by 7. For equity, the weightage is 3 by 7. Yeah. So weighted average cost of capital is 10%. So we got the weighted average cost of capital. We got the no PAT. We have the total invested capital or total capital employed. Now we can simply get the economic value added to be not operating profit after tax minus WACC into total capital employed. Right, so net operating profit after tax is 84 minus 10% into 700. Minus 10% into 700. So we get the economic value added number to be 14. Value added number is 14 lakhs. Okay. Are we clear with this? The economic value added concept base? Yes. Easy. Simple. So there are only 2 stages. First is to get the net operating profit after tax, right? Second is to compute the weighted average cost of capital. And then we just need to simply apply this formula of NOPAT minus back into total capital employed. Right? Simple. So that was question number 9. Let's take up the next question, which is question number 10. Let's look at question number 10, guys. RST Limited's current financial year income statement reported its net income after tax. So net income after tax is given to us, which is 25 lakh. Right? So this is your after tax income. So we need to get the profit before tax and then to reverse calculation maybe. Let's have a look at the further part of the question. The applicable corporate income tax rate is 30%. Following is the capital structure of RST Limited at the end of current financial year. So coupon rate is 40 lakhs. Equity, which is having a share capital and reserves and surplus, is 125 lakhs. Invested capital is 165 lakhs. Okay, so debt, which is a coupon rate of 40 lakhs, equity, share capital and reserves 125. Total capital invested is 165 lakhs. Following data is available. So we have the equity beta of RST Limited. Then we have the risk-free rate and market risk premium. So remember, this 9% is RM minus RF. This is RM minus RF. We are required to calculate the weighted average cost of capital of RST Limited and estimate the economic value added of RST Limited. Okay. So to compute the WACC, we need the cost of equity. Right? We need the cost of equity. And then, of course, we need the cost of debt also. So let's do it one by one. This is question number 10. Okay. So first we need to look at cost of equity as per CAPM. We know as per CAPM, cost of equity is RF plus beta into RM minus RF, right? Now, do we have the risk-free rate given to us? Yes, the risk-free rate is 8.5% and 9% is already given as RM minus R, right? So risk-free rate is 8.5%, 8.5%. That we are going to add beta of 1.36. Of 1.36 multiplied by RM minus RF is 9%. This is 8.5% plus 1.36 into 9%, which is 20.74%. So cost of equity as per CAPM, we say it is 20.74%. The next task is to compute the cost of debt. Now, cost of debt will be, of course, based on the rate of interest over here. Coupon rate is 11%. So to make it a after-tax cost of debt, I need to adjust the tax. So that's going to be 11% into 1 minus 0.3 because tax rate is 30%, right? Correct. So tax rate is 30%. So we get the 11% into 0.7, which is 7.7%. Cost of debt is 7.7%, right? Then what about the weighted average cost of capital? Weighted average cost of capital is simply into cost of equity plus weight of debt into cost of debt. So weight of equity is 20.74% into weightage of equity will be 125 out of 165. Into 125 out of 165. To that, you will add 7.7% into debt is 40. So it is 40 divided by 165. Right? So this is like 17.57%. Or weighted average cost of capital is 17.58%. Now, we've got the WACC, the one part of EV, which is WACC into the total capital employed, that is sorted. Now, the next part I need to do is post-tax EBIT. Now, of course, for that, we have been given profit after tax. So profit after tax is 25 lakhs, which is after deducting 30% tax. So profit after tax is 25 lakhs. So we know profit before tax will be 24 lakhs into, or rather this is going to be divided by 0.7 because that's a 30% is the tax rate. So this divided by 0.7. This is going to be the profit before tax. And of course, to that we are going to add the interest, right? To that we are going to simply add the interest. Well, the interest needs to be computed as, on a 40 lakh, 11%. 40 lakh into 11%, which is 4 lakh 40,000, right? So if you take a sum of these two, this is what we call it as EBIT. So EBIT is 40 lakh 11,429. Okay, so EBIT is 40 lakh 11,429. Now we need to get the net operating profit after tax, which is EBIT into 1 minus the tax rate, right? So this is your EBIT. We need to multiply it with 1 minus 0.3 or EBIT into 0.7, which is 28 lakh 8,000. That's your net operating profit after tax. So this is done. The other part is to get back into invested capital. Weighted average cost of capital into total capital employed. We have the WACC number, which is 17.58%. That's 17.58%. Yeah, multiplied by total capital employed is 165 lakhs. 165 lakhs. So this is 17.58% into 165 lakhs. Right. It will be the final figure of EVA, economic value added. That will be a negative case in this question. So there is no value addition by this company. The other company has performed below the expectation of the investors. And therefore, EVA, when it is negative, it indicates that the company is not performing well, and rather the company is having a return which is lower than the expectation. Right? Are we clear, guys, with this question 10? Simple question. Correct? Yes, perfect. Then let's go for question number 11. Question number 11. Try to solve this question number 11 quickly, guys. Solve it on your own quickly. Question 11. I think you should be able to do it within a fraction of like maybe a couple of minutes. I'll just give you like 2 minutes for this. Give me the give me the first two answers, A and B. C we will discuss, but just give me these two numbers. Operating income, which is basically your EBIT, and second is get me the EVA, guys. Give me these two numbers, calculate and tell me these numbers quickly, 2 minutes time, and then we'll look at the part C.
Jagbantu ji, any issue?
Oh, sir. Just given them time to solve this. Got the operating income? Okay. So, operating income 31 lakh 42 7. Right. So, this is your operating income, or this is what we call it as a EBIT, right? Okay. So, from this, you can get the what you say, NOPAT. Right. Okay. NOPAT is 22 lakhs. Okay. Perfect. Then back into total capital employed. But weighted average cost of capital is already given to us, right? It's 13%. So it's going to be 13% of invested capital is 95 lakhs. This is going to be 95 lakhs into 13%, which is 12 lakh 35,000. So it's quite obvious that economic value added is just the difference between these two. So economic value added is 9 lakh 65,000. Okay, so this is similar to what we have done in the previous couple of questions. Now in this question, there is an additional thing which is asked, which is Tender Limited has got 6 lakh equity shares outstanding. How much dividend can the company pay before the value of entity starts declining? Okay, so there are 6 lakh equity shares outstanding, and how much dividend can we pay? Now to understand it, this is a very simple concept that the company has generated this excess return, 9 lakh 65,000. So ideally, the value of the company will increase by this amount because this is the additional value. This is the additional, return which the company has generated for its stakeholders. So the value of the company should ideally increase by this 9 lakh 65,000. However, if we are going to pay out the dividend, the value will, get reduced by that amount because there's a fund outflow from the company. So how much can we pay dividend? EVA, when we say dividend, if you don't pay this dividend, if you don't distribute this additional return generated, the value of the company is going to increase because this is going to stay within the company. But if you're going to pay the dividend, the maximum dividend which you should pay without having any effect on the value is going to be the maximum total dividend of 9,65,000. So per share, it's going to be like 9,65,000 divided by 6 lakh equity shares. So this is going to be 9,65,000 divided by 6 lakh. So maximum dividend which you should be, willing to pay is 1.6083, and this will have no effect on the value of the business because value of the business will continue as it is because you have just paid out what is supposed to be the excess return which you have generated. Okay, so that's the simple question number 11. I hope it is clear to everyone. Yep. Are we all done? Perfect. Okay, then let's go for the next question, which is question number 12. So the following information is given for 3 companies that are identical except for their capital structure. So we have 3 companies, Orange, Grape, and Apple. Total invested capital is 1 lakh in all the companies. So all 3 companies are having the same invested capital. Debt to assets ratio is given to us. Okay. So when we say debt to assets ratio, out of total assets, 80% is funded by debt in case of orange. In case of grape, it's 50%, and in case of apple, it is 0.2. Right. Then we have the number of shares outstanding, pre-tax cost of debt, cost of equity, and EBIT is given to us. The tax rate is 35% for all the three companies. First, we have to compute the weighted average cost of capital for each of the companies, compute the economic value added for each company. Based on the EVA, which company would be considered for best investment? Then if the industry PE ratio is 11x, then we have to estimate the price of the share of each company and calculate the estimated market capitalization for each of the companies. Right? So the tax rate is supposed to be uniform, 35% in all cases. So we have to get it one by one. Let's get started with the computation of WACC. Now to compute WACC, we need the individual costs and we need the weights, right? So let us name it as orange, grape, and apple. So we have like the value of debt given to us, rather we have the debt to assets ratio as 0.8, 0.5, and 0.2. So total invested capital is 1 lakh. Total capital is 1 lakh. Right? 1 lakh for all the three cases. And the question has given us the weightage of debt. Weightage of debt is simply 0.8, 0.5, and 0.2. From this weightage of debt, we can simply get the weightage of equity also. Weightage of equity is going to be 1 minus weightage of debt, which is 1 minus 0.8, 0.2, 0.5, and 0.8. The weightage of equity is 0.2, 0.5, and 0.8, right? Now, weighted average cost of capital for each of the companies. So we would need the cost of debt. We will need the cost of equity. Now, cost of equity is given to us 26%, 22%, and 20%. The cost of debt is like 26%, 22%, and 20%. Then this is cost of equity. Now, cost of debt is pre-tax is given to us. So we need to take it as a post-tax figure. Pre-tax AD is 16%, 13%, and 15%. So if you want to make it as a post-tax KD, this has to be multiplied with 1 minus tax rate. So tax rate is anyways given as 35%. 35%. So post-tax cost of debt will be pre-tax KD multiplied by 0.65. Is going to be 16% into 0.65. These are the cost of debt, pre-tax cost of debt. So we have the cost of debt, we have the cost of equity, we have the weightage of debt, we have the weightage of equity. Now we can get the weighted average cost of capital. Cost of equity into, or weightage of equity into cost of equity plus weightage of debt into cost of debt. So this is going to be weightage of debt into cost of debt plus weightage of equity into cost of equity. That's 13.52%, 15.23%, and 17.95%. So that's the first part that's done, which is weighted average cost of capital. Second is to compute the economic value added. Now, to compute the economic value added, we obviously have these EBIT numbers. So I just need to convert it to post-tax. NOPAT, right? So let us look at the EBIT numbers. EBIT numbers are 25,000. Rather, it's just the same 25,000 figure for all of them. We need to make it as a net profit after tax, which will be EBIT into 1 minus tax rate. So that will be 25,000 into 0.65. Right? So 16,250. That will be the net operating profit after tax. Right? NOPAT is EBIT into 1 minus 2, which is 16,250. Right? Then after that, after the NOPAT, we need the EVA number. So I need to get the weighted average cost of capital to total capital. Well, weighted average cost of capital is already computed by us. That will be multiplied by total capital employed. Right? So NOPAT minus total cap minus WACC into total capital employed, which will give us the EVA. So EVA is NOPAT minus weighted average cost of capital into total capital employed. I just need to take the difference between the both of them. And what we get is EVA for Apple is negative, whereas for others it is positive. Now, based on EVA, which company should be considered for best investment? Now, of course, based on EVA, highest EVA has been generated by the Orange, and therefore we should make fresh investment into Orange because there the EVA is a bit higher number. Okay. Then we say the industry P ratio is 11x. We have to estimate the price for the share of each company. Calculate the estimated market capitalization for each of the companies. So we have been given that industry PE ratio is 11x. And we have to estimate the price and the market capitalization also. So let's do it with EBIT numbers. EBIT numbers are given to us. From that, we need to subtract the debt. Not the debt, sorry, interest. Right? So the interest will be subtracted by simply taking it as total capital employed into weightage of debt into pre-tax cost of debt. Total capital employed into weightage of debt into pre-tax cost of debt. Right, so 12,800, 6,500, and 3,000. That's our EBIT. That's our interest amount. And we will get the profit before tax. That is 25,000 minus 12,800, 25,000 minus 6,500, and 25,000 minus 3,000. So that's your PBT. From that, we are going to reduce the tax, which is 12,200. On that, there's a tax of 35%. So we subtracted the tax. Then we have the profit after tax, which is 12,200 minus the tax, which is 4,270. We get the profit after tax figures. Now from that, how are we going to get the share price? Since the P ratio is given, we need to divide it by number of equity shares, right? So that we get the EPS. That EPS will be multiplied by P ratio, which will give us the market price per share. What's the number of equity shares given to us? The number of equity shares is like shares outstanding, the count of shares is given to us. So that's 6,100, 8,300 and 10,000. 8,300 and 10,000. So EPS will be 7,930 divided by 6,100. And the other numbers are obtained on a similar lines. So PE ratio is given as 11x. Now market price per share will be EPS into PE ratio. So we get the market price as 14.9, 14.3, 15.94 and 15.73. Right. So now if we want to calculate the market capitalization, that will be nothing but NPS multiplied by number of equity shares. So 14.3 into number of equity shares is 6,100 in this case. So these are the market capitalization. Is very good, guys. Simple. Is it clear? Correct. Okay, perfect. So that was question number 12, where we were looking for calculation of the market capitalization along with the EVA part. Now, let's go for the next one, which is question number 13. Okay, question 13. Question 13. Delta Limited's current financial year's income statement reports its net income as 15 lakh. Now, of course, this net income is nothing but what we mean as profit after tax. Delta's marginal tax rate is 40% and its interest expense for the year was 15 lakh. The company has 1 crore of invested capital, of which 60% is debt. In addition, Delta Limited tries to maintain a weighted average cost of capital of 12.6%. So current financial year income statement is having a net income of 15 lakh. Marginal tax rate is given, interest expense is given. Company has 1 crore of invested capital. So out of that 1 crore, 60%, which means 60 lakh is in the form of debt. In addition, Delta Limited tries to maintain a weighted average cost of capital of 12.6%. So we got a WACC number of 12.6. You have to compute the operating income or EBIT earned by Delta Limited in the current year. So you have to calculate the operating income or EBIT, which is earned by the Delta in the current year. What is the Delta Limited's economic value added for the current year? Delta Limited has 250,000 equity shares outstanding. According to EVA, how much can the Delta pay in dividend per share before the value of the company would start to decrease? If Delta does not pay any dividend, what would you expect to be happening to the value of the company? Okay. So what we have as information in question is a profit after tax figure. So profit after tax is 15 lakh. The tax rate is 40%, right? So can you tell me what will be the profit before tax? Can you tell me what will be the profit before tax, guys?
40 lakh.
10 lakh
37 lakhs 50,000.
15 lakh divided by 1
40%.
minus 40%. So that's 25 lakhs. Right? So it's still 25 lakh because out of 25 lakh, you would have paid out the 40% as tax. So 15 lakh is what is left out. So profit before tax is 25 lakh. Okay. So of course to that, we will add interest. Interest is 15 lakhs. And EBIT is like 25 lakh plus 15 lakh, which is like EBIT is 40 lakhs. Right? So EBIT is 40 lakhs. Net operating profit after tax will be EBIT into 1 minus tax rate, which is 40 lakh into 1 minus 0.4. So NOPAT is 24 lakhs. Then weighted average cost of capital into total capital employed. That is anyways given to us in the question. So EVA can compute as net operating profit after tax minus weighted average cost of capital into vested capital. Net operating profit after tax is 24 lakh minus weighted average cost of capital is 12.6%. So 12.6% into what is the amount of capital invested? Capital investment is 1 crore. The EVA number as 24 lakhs minus 12.6% into 1 crore, which is 11 lakh 40,000. Economic value added is 11 lakh 40,000. Then they say Delta Limited has got 2 lakh 50,000 equity shares outstanding. According to the EVA which we computed, how much can the dividend be paid? So EVA dividend will be how much? EVA dividend will be like this 11 lakh 40,000 upon the number of equity shares that it has got is going to be 2 lakh 50,000, right? Lakh 50,000. We have 11 lakh 40 divided by 2 lakh 50, which is 4.56. The economic value added dividend is 4.56. Then they say if the company doesn't pay any dividend, what would you expect to happen to the value of the company? So what would you expect to be happening to the value of the company if the company is not going to pay the dividend? What is going to happen? If the company is not paying out dividend, what will happen? Obviously, the value of the company is going to be higher because it will be able to achieve a higher growth rate, right? The value of the firm is going to increase if it is not going to pay out the dividend because there has been a value addition by the company to the extent of 11 lakh 40,000. Okay, so that's question number 13. I hope this is clear. Question 13 is clear, everyone. It's a simple question. Let's go for the next, which is question number 14. Okay. So in question 14, we have like following data pertains to XYZ Inc. engaged in software consultancy business as on 31st December 2010. Income from consultancy is 935, EBIT is 180. So this is basically your revenue. 935 is basically your revenue. On that, you have a EBIT of 180. Interest on loan is 18. Profit before tax is 162. Tax is 56.7. And then you have a profit after tax of 105.30. Then we have the balance sheet item, which is land and building, computers and software, and then the current assets. Over here, you have equity stock, reserves and surplus, loans, and current liabilities. The total of asset and liability will be 785. We have to calculate something called as economic value added and also something called as market value added. Now, what is this market value added? We'll get to it in a short time. So let's now just focus on economic value added. Okay. When we're computing the economic value added, we of course start with EBIT. EBIT is 180. Now, of course, to make it suitable for computing the economic value added, we need to calculate NOPAT. NOPAT is EBIT 1 minus tax rate is equal to 180 into 0.65, which is 117, right? Now from that, we need to subtract the VAT into invested capital. So first we need to get the weighted average cost of capital. Well, VAT is given as 12% and total capital employed is to be 12%. And what's the total capital employed? The capital employed is
Net asset.
net asset, or no, it will be also including like equity share capital, reserves, and loans, all three of them. So that will be like 100 plus 325 plus 180. That will be 100 plus 325 plus 180, which is 605. Right? So you can get over here weighted average cost of capital into total capital employed is 605 into 12%. $605 into 12%, which is 72.6. So finally, we can say that economic value added is 117 minus 72.6, which is 44.4. The economic value added is 44.4. Right? That's the first part done. Now coming to the market value added. Market value added is simply the market value of the equity shares and the book value of the equity shares. So any addition that you have made in the market or any addition that you have made in the market value is going to be simply the difference between these two, which is the market value of the equity shares and the market value of the equity fund. I mean the book value of the equity fund. So we'll say, what is the amount of equity shareholders wealth or equity shareholders fund, which is also called as the net worth. So net worth is simply equity share capital plus reserves. So equity share capital is 100 plus reserves of 325. 100 plus 325, which is 425. Right? So net worth is going to be 425. What is the market value of equity stock? Market value of equity stock, the share is currently traded at 50 and there are 10 million shares. So the calculation will be 10 million into 50 rupees each. Right? So that will be like 500 Both are obviously in million terms. So the addition that we have created in the market value is 75. So that's your market value. The market value is nothing but market value of equity minus book value of equity. Simple. Here is simple calculations. The calculations. So that's question number 14. Then let's take up question number 15 next. Let's take up question number 15. Herbal Gyan is a small but profitable producer of beauty cosmetics using the plant aloe vera. This is not a high-tech business, but Herbal's earnings have averaged around 12 lakhs after tax. So this is your profit after tax, right? So you have given the profit after tax figure. Then this is not a high-tech business, but Herbal earnings have averaged around 12 lakhs after tax, largely on the strength of its patented beauty cream for removing the pimples. The patent has 8 years to run. Herbal has been offered 40 lakh for the patent rights. Herbal's asset include 20 lakhs of working capital, 80 lakhs of property, plant and equipment. The plant is not shown on the Herbal's books. Suppose Herbal's cost of capital is 15%. What is the economic value added? So this patent is not shown in the books, but it's obviously part of your operating assets, right? So we say, what are the operating assets that the company is having? So in the operating assets, we'll obviously have the working capital, which is our operating asset, 20 lakh. Then along with that, we have got PP or property, plant and equipment. Property, plant and equipment of 80 lakhs. Right. But apart from that, we also have the patent. So patent is definitely a working capital, I mean, an operating asset. So 40 lakh is what we take over here. And then we have like total operating assets. Total operating assets is total 140 lakhs. Right. Now the question has given us that cost of capital is 15% and we have like earnings is 12 lakh after tax. So we have profit after tax of 12 lakhs, largely on the strength of just average around after tax figure is this. Now, there's no, what you say, interest or anything has been specified. So we can definitely say that this is simply EBIT into 1 minus tax, which is our net operating profit after tax. The net operating profit after tax is 12 lakh. And then we say weighted average cost of capital into total capital employed. Now, total capital employed will be same as this operating assets which you have in the business. So, weighted average cost of capital is 15%. So, that's 15% into 140 lakhs. So, 140 lakhs into 15%. So, what will be the net of both of them? Well, we have got a negative economic value added here. There's a negative economic value addition of 9 lakh. Right? So 15%, there's a negative economic value addition. Easy question. Now let's go for the next question, which is question number 16. Okay, look at this question 16, guys. Like to try it on your own? Would you like to try this question? You have to compute the economic value added.
Yes, sir.
Yeah, okay. So I'll just put up a timer. You should be able to do it like within 6 minutes. Yeah. Try out this question number 16, guys. Constant Engineering Limited. The economic value added by the same technique what we have been doing. You have to get the NOPAT and then simply subtract it by the weighted average cost of capital into total capital. Over here, you can say that Constant Engineering Limited, it has developed a high-tech product which has reduced the carbon emission burning of a fossil fuel. So we want to see whether there is any value addition due to this new technology that has been developed. Okay. So for that, of course, you can see there's some operating profit or EBIT that would have been given, right? Net worth of the company is given to be 200 crores. Market value of a patent is also given. And we have a long-term debt is also of 400 crores. Revenue is given, rate on 365-day government bond is given as 10% per annum. And then market portfolio generates a return of 12%. So you have to calculate basically KE first, cost of equity using the CAPM model, right? Try to solve it. You should be able to do it. I hope you're able to calculate it. 70 crores. B. Okay. I'll calculate it. Let the timer go off. Okay, so time is on. Now let me just try to solve this. Let's see if you have got it correct. Okay, so here we have the product is in high demand. The product has been patented and has a market value is not recorded, but in net worth is given as 200 crores and long-term debt is 400 crores. The product generates a revenue of 84 crores. And this is basically your revenue. Now we have to first get the the cost of equity for our calculation, so the cost of debt, right? So we need to get the cost of equity. The market portfolio is generating 12%, and on the government bond we have a rate as, let's say, 10% per annum, right? So now first let us calculate the total operating assets. Operating assets. So operating assets will comprise of which will be the net worth plus the long-term debt. Net worth is 200 and long-term debt of 400. But we still have that patent, which is not yet recorded in our books. So patent right is like 100, right? Is not recorded. Net worth of the constant engineering is 200 crores. Long-term debt is 400 crores. That is done. So we say total investment that we would have made in this company is like 700. Now on that, of course, we need to get the EVA. So for that EVA, do we have the weighted average cost of capital yet? No. So let's say weighted average cost of capital is KE into weight of equity plus KD into weight of debt. Okay. So KE is not specified as such, but market portfolio, they are saying it is 12% and debt is 10%. I mean, government bond is 10%. So based on these numbers, we just would have to make an assumption that the return on equity will be same as the market return and return on debt will be same as the government, because there's no other way out by which we can compute the weighted average cost of capital. So here the KE will be taken as it is 12%. That's going to be 12% into weight of equity that is already computed as, net worth is 200 plus, of course, the patent right will also go to the equity. So therefore, it will say 300 out of 700 plus cost of debt is, we'll take it as 10% into 400 out of 700, right? So weighted average cost of capital, 12% into 300 by 700 plus 10% into 400 by 700. So we get the weighted average cost of capital to be 10.85%, right? So this is the only way by which we can get the weighted average, because there's no other information available in the question. And now we have to take this revenue itself as the profit earned, right? So a lot of assumptions and information in this question. So when we say EVA, we'll say it is profit earned minus weighted average cost of capital into total capital or into the total investment. Profit earned is 80 minus 10.86% into total investment of 700. Right. So that will be 84 minus 10.86 into 700. So we get an economic value addition of 8 crores. Approx 8 crores. So it will be 7.98 or 8 crores approximately, because that may vary. That may change from person to person because depending on the decimals that you take. Okay, so that's the question number 16. So we have like covered the practical questions, whatever we had. But there are some concepts that we need to discuss in this particular chapters. We will be going ahead with the discussion of those concepts in the remaining sessions. Okay, with of course certain examples and certain numbers, right? There is some concept called as EV EBITDA multiple, or there is a part called as EV EBITDA multiple, or EV EBITDA multiple is used to calculate the enterprise value as a multiple of EBITDA. Okay, so let's look at that EV EBITDA multiple, and then also we'll take up some other relative valuations. Of course, we have seen the relative valuation to be using like price to earning ratio, but also one prominently used method is calculate the EV EBITDA multiple of other entities. Okay. Enterprise value EBITDA multiple. So let's look at this particular aspect. Yeah. Enterprise value to EBITDA multiple. First, we need to know what is this EBITDA number. Are you aware of this EBITDA number? Yeah, guys?
So earning before interest, tax, depreciation, and amortization.
Yes. So this is earnings before interest, tax, depreciation, and amortization. Right? Earnings before, this is your earnings before interest, tax, depreciation, and amortization. Right? So this is a number which is used widely in carrying out relative valuations. Right? So this is again a market-based approach only, where instead of P, we are using the EBITDA numbers. Okay. In case of this calculation, enterprise value, what do you think? What will comprise of enterprise value? How do you get the enterprise value? This is simply market value of equity plus market value of debt. So enterprise value is simply market value of equity plus market value of the debt. Right? So how is this typical number used while carrying out the valuation? So let us say there are 3 companies into the same line of business. the same sector or same business. Let's say there are 3 companies and we want to carry out the valuation of this company D. This company has got an EBIT of let's say yeah. So suppose if I tell you that we have a profit after tax figure for the 3 companies. Now, when you want to say the profit after tax, let us say this company has got a profit after tax of 130, the other has got a profit after tax of 140. Then this has got a profit after tax of 90. Now, if I give you information regarding the interest, regarding the tax, regarding the depreciation. So interest is, let's say, 30, tax is, let's say, 40, and depreciation was 25. Right? So from that, when I want to compute the EBITDA, that's going to be just adding up all of them.
225.
Right? So we can get the EBITDA number, which is earnings before interest, tax, depreciation, and amortization number, as just a sum total of all of them. Okay. So similarly, you do the calculations of B and C for EBITDA also. So let's say EBITDA for C works out to be 260, and for this works out to be, let's say, 170. Okay. So you can get this EBITDA by simply adding PAT plus interest plus tax plus depreciation. And if you start with EBIT, you just need to add back the depreciation and amortization. Okay. Now, market price per share of this company is 12, 140, and 600. And then I say that the number of equity shares is over here, let's say 100. Then this may be 9. And this is 2. So market value of equity will be market price per share into number of equity shares. So we arrive at this particular market value of equity. Or let me just take it as 1.5. Yeah. We arrive at the market value of equity. Same way, market value of debt is, let's say, that is 400, it's 200, and this is 80. So we get the enterprise value to be total of the equity value and the debt value. Okay. Now, if I ask you, what is the EV EBITDA multiple? What is the EV EBITDA multiple for company A? What is the EV EBITDA multiple for company A? Simple. Enterprise value upon EBITDA, which is 7.11. Right? So EV EBITDA multiple for company A is 7.11. For company B, it is 1460 divided by 260. And for company C, it's 980 divided by 170. So we have got 3 companies and all of them are having different EV EBITDA multiples. And I say that this company D has got a EBITDA of 35. How do I calculate the ideal enterprise value or an average enterprise value for company D? Can I say 3 EV EBITDA multiples are there?
EBITDA multiple.
We'll take the average EV/EBITDA multiple. Right. So average EV/EBITDA multiple will be simply average of these three numbers. So average of EV/EBITDA multiple is 6.16. So I can say that the company B has got this average value. I mean, this EV/EBITDA multiple, right? So we can say value of D will be simply this average EV/EBITDA multiple into the 35 EBITDA. So value of this company should be working out to be, 215 bits, right? Whatever is the currency. So this is how we simply use the EV/EBITDA multiple. For the comparable companies, we take the EV/EBITDA numbers, right? And then that particular EV/EBITDA number is used for obtaining the value of the target company or the other company. Are we good? Do you understand this concept of EV/EBITDA multiple valuation base? Yep. Okay. So there are many other different aspects also for valuation. The valuation of a company will differ from one industry to another industry based on the structure of the industry, based on the way business is developed, right? Based on the factors that are going to influence the industry, it's all going to be different, right? Especially, we are like interested in carrying out valuation of the new age companies, and specifically there are certain special type of companies which needs our attention. Okay. Now, we'll look at individually valuation of separate types of companies. Let's say we want to undertake a value of a distressed company. To undertake, let's say, valuation of distressed companies. Now, how are these how are the distressed companies different from the other companies? What is something that is missing in distressed company and which is there in the regular companies? What is something that is missing in the distressed companies? What assumption can we really not take with reliability when it comes to distressed companies? First up, understand what is a distressed company. What do you mean by a distressed company? A distressed company is simply, those businesses or the companies, those businesses or companies which have defaulted, on their debts. The distressed companies are those companies which have defaulted on their debts. It means the companies which have defaulted. So basically, there was some amount of debt which was due from the company, and that debt has not yet been recovered, or that debt, company has not paid the EMIs. Right? So these distressed companies are businesses which are likely or already have defaulted on their debts, which have defaulted or are likely to default on their debts. So it's like fair chance or a higher chance that the company is going to default, right? Does that mean the company has got no value? If the company has defaulted on its loan repayment, does that mean the company has got no value? No, of course, company is going to have some amount of value. So although a company may not be, making the payment on some, but they will be obviously like, company would have, default has happened. So there's a problem with the company. That doesn't mean that the company is worthless. But for these companies, we cannot use conventional methods. Discounted cash flow method, I cannot use it. Right? So conventional methods are not deployed for valuing the companies. So what could be the reasons? Reasons why DCF cannot be used for these companies. What would be the reason? First thing, in the normal companies, we assume that the company is going to exist forever, or there is going to be a perpetuity. There's going to be a perpetual succession in the company. But that concept or that understanding of having a perpetual succession in the company is not remaining with these distressed companies, because perpetual cash flows may not be assumed because it has already defaulted, and you never know, the company may be wound up anytime, right? So that perpetuity is something that is missing over here, right? So we can say assumption of perpetual cash flows. The assumption of perpetual cash flows is not valid. Assumption of perpetual cash flows is not valid, as the assumption of perpetual cash flows is not valid as negative cash flows in these companies. These companies have got a negative cash flows if we account for the interest payment, right? So first thing is that. Second is, a distressed firm is obviously having negative or declining revenues. Hence, obviously, you're expecting to lose money in future. And for such firms, estimating cash flows is going to be difficult, right? So there is a high risk of bankruptcy. There are high chances that the company may default. So for the firms which are likely to default, which are likely to fail, discounted cash flow doesn't work, since discounted cash flow assumes it on a going concern basis. So going concerns are which is something absent in this distressed companies, right? So if we use discounted cash flow, it may yield negative value, as there are negative cash flows from the business, right? And the third reason why we cannot use discounted cash flow, discount rates used in conventional methods reflect the operational and financial risk. Now, when you are using the discounted cash flow for this distressed companies, the discounting rate is also going to be higher. So high discounting rate may be used, right? So high discounting rate may be used, which will further lower the value, right? So the only thing, method by which we can undertake the valuation of a distressed company is to look at it and from the point of view of liquidation. Should look at the company from the point of view of a liquidation. That suppose if the company goes into liquidation right now, what will be what will be the way by which you are going to realize the cash flows, right? So some of the methods that we use for valuing the trust companies is something called as, first is modified discounted cash flow method. So use a modified discounted cash flow valuation. This method requires coming up with probability distribution. Like you'll look at the probabilities and then cash flows, right? So while computing the cash flows, the likelihood of default should be adjusted. In conjunction with these cash flow estimate, discount rates are also going to be estimated using the updated debt equity ratios, and also default risk is taken into account, right? So you need to write down what all probabilities will be there and then look into the cash flows. Like you may have a probability of 10% that you will have a cash flow of maybe 1,000, then 0.3 probability that your cash flow may be 500, right? Then maybe for again the cash flow being, let's say, negative 100, and maybe you can say another 0.1 or 0.2 chance that there will be a negative cash flow of 300. You prepare this sort of discounting, and for each of the scenarios, you obtain the value, and then you simply take the expected value, right? So expected cash flow that you can think from over here is the cash flow into 1 minus probability distress. Right? So you'll say, let us compute the expected cash flow from this business. This will be like, take the cash flow, you multiply it with 1 minus probability of distress. Expected cash flow will be cash flow into 1 minus probability of distress. Right? Right. So expected cash flow is cash flow into 1 minus probability of the distress. Okay. So modified discounted cash flow valuation. We use the chance of default. We take the chance of default. So 1 minus chance of default, it means we're looking at the chance of the company doing good. And then the probability of company doing good is multiplied with the cash flow to arrive at the expected cash flow that you can get from it. Right? So over here, once you have obtained this, then you can get the value of equity as simply value of equity over here. You can get it as discounted cash flow value of equity will multiply with 1 minus probability of distress, right? And plus distress value of equity, and then you multiply it with probability of distress. So like you use the discounted cash flow, you arrive at the value of the equity by using discounted cash flow technique. You multiply to the probability of no distress. And then you take the value of equity. Suppose the company goes into liquidation. What will be the value that is realized from the equity? That you multiply it with the probability of distress. So for example, if the company is going to default, so you may say no default or default. If there is no default, of course, we'll need to look at the probability also. So no default probability is, let's say, 40%. Default probability is, let's say, 60%. If the company doesn't default, then the value will be 230. If the company goes for defaulting, the value that you will realize is just 12. I mean, by liquidation, by selling off assets and all, the value that you realize is 12. So you can calculate the value of the company by simply taking probability multiplied by value. You multiply probability with the value, and then you simply take the sum of these two. So that's the 99.2 is the value of E. Right? So you simply use the probability concept to multiply the value without distress into probability of no distress, and multiply the value with distress into probability of distress. Okay. Then one more thing which we can generally expect is to calculate something called as adjusted present value. Well, adjusted present value, we compute it for valuing the distressed companies by simply taking the value of unlevered company. The value of the unlevered company, right? So unlevered firm value. So we'll look into a comparable company in the market which has got no gearing or no leverage. So we need to take that unlevered firm value. To that, we are going to add tax benefits of debt minus expected bankruptcy cost of debt or expected bankruptcy cost debt. So it is like adjusted present values. Take a firm which is not under distress. You add the tax benefit which you have due to the debt, and then subtract, like if there is some bankruptcy cost, like so there is some debt from which you are obviously facing some bankruptcy. You subtract that expected bankruptcy cost from the debt. So when, like, if there is a bankruptcy happening, what is the cost that you need to bear? That is what you're going to subtract from that, right? Now, how do we get this expected bankruptcy cost? The expected bankruptcy cost is calculated as simply unlevered firm value minus distress sale value. Now, distress sale value is like if you're going for liquidation, the unlevered firm value minus distress sale value, right, multiplied by probability of distress. The expected bankruptcy cost is unlevered firm value minus distress sale value multiplied by the probability of distress. If you multiply the chance of your business going failure, this is what you're actually losing, right? So if the business is an ongoing business, it will have a different value. If the business is put up for sale, it will have a different value. So you take the difference between them, difference between both of them, and then you multiply it with the probability of the distress. So that is going to give you the expected cost of bankruptcy. Okay. Correct. So that's how you do the valuation of a distressed company. So distressed companies, basically those companies which are under stress or they don't have enough funds to pay off their debt. These are some of the concepts that we use for valuing the distressed company. Yeah, one more thing that we do for distressed companies is to undertake a relative valuation. Relative valuation. It implies like you simply take the relative valuation by taking enterprise EV EBITDA multiple, and maybe you can use sales to EBITDA also, right? So, for example, you'll say regular sales to EV value, right? It's like, let's say 2x. But for distressed, you may say that it's not 2x, it may be 1.25x because of the chances of the company going into default. So you look into, like, in the past, the companies which have gone into default, how much money has been realized from them. As compared to the sales, you use the multiple and then simply use that particular number to get the relative valuation. Okay. So relative valuation by way of sales multiple, or you can even take the EV EBITDA multiple to calculate the relative valuation of the company. Okay. So now let's do one thing. Let's take a break. And after that, we will take a look at what are the ways to value the startups. We'll look at the startup valuation, right? And then maybe look at something called as ESG concept and ESG framework also. Okay, let's take a break, guys. I hope we are back after the break. Yeah. So now we'll look into the valuation of the startup companies or new age companies to be more specific, right? We are looking at the concept of valuation of startups. So we already know there are certain methods by which we can value the business. Broadly, it is like three categories. One is the earnings or cash flow approach. Second is the asset approach. And third is the market approach. Right? So you already know these typical methods. Right? So one common feature in above approach is that it presupposes or it assumes, I mean, these three methods are under an assumption that the business is going to be valued. I mean, we are assuming that business is going to generate cash flows or profits, right? So one common assumption that we have in all the three things is business is established and generates cash flows using its assets, right? But if you look at, and there is an assumption here that business generates cash flows. But that is something which is missing in case of a startup company. So a startup company is not something which is, established. It is not something which is in a position to generate cash flows, right? So we say that these particular companies are definitely in their nascent stages, in the initial stages, and they are trying to establish themselves in the market, right? And for these startups, you don't have these profits or cash flows coming in easily. So often bringing in like the valuation of startups is often required for bringing in additional equity. Like we need to undertake the valuation of companies when we want to bring in new equity or debt into the company. However, the most significant differentiating factor in the valuation startup is that there is no historical data on the basis of which you will be able to undertake projection. So in startups, these methods may not apply. In startups, these methods may not apply for a simple reason. They are not established. First is, of course, they are not established. Secondly, they may not generate cash flows. Thirdly, first is they are not established. Second is they may not be generating the cash flows. And thirdly, we can say no historical data for forecasting. So we don't have any historical data for forecasting the future projections, right? So there's no base on which you're going to forecast the future. So value of the startup, it entirely depends on the untested idea or maybe just sample of the consumer behavior, maybe the type of the product that you're looking at. The estimated future growth is also based on assessment of the, how the startup is going to drive its business, right? Or maybe most often it's like a belief or a gut feeling which the promoters or which the founders are believing to be, right? And so there is no base on which you will be able to calculate a sound value, right? So past performance indicators are not there, right? There is no fast track record and only a future whose narrative is controlled based on the founder skill. It can be equated as founders walking in the dark And investors believe that one fine day will be on the other side of it, right? While this is exciting and of course fun for the founders, for the investors, it's very risky. So valuation of the startup becomes a very critical, and that's where the role of professionals come in, right? Because navigating the dark through fairy tales or through just by looking at whether the idea is going to be successful or not, that is something it's a bit gloomy atmosphere to look into the valuation. Now, traditional methods, as I said, it cannot be applied because they're not established, they're not generating cash flows, no future method is there, right? So if we specifically look at each one of them, why would earnings or cash flow approach not be feasible? Income approach, or I can say non-feasibility of income approach. Now, non-feasibility of income approach is due to because all the startups are under an assumption that they're not going to have positive cash flows in the immediately upcoming future. Right? This business model has been accepted and normalized by the investors community that, okay, initial days you may not be able to generate cash flows, or there is no, or you can say there is no cash flows, or maybe minimal cash flows at first. And therefore, we'll say that income approach is not feasible. So this is due to non-availability of profits or cash flows, right, in initial days, right? So there is non-feasibility or non-availability of the profits or cash flows in the initial days. Second is, why can't we really use the asset-based approach? Why can't we use the asset-based approach? Like we can simply take the value of all assets, right? Why can't we do that? Because most of these assets, most of these startups are based on just idea. They don't have any large assets like in the form of plant and machinery, any plot of land or any building. They don't have as such, right? So startups have negligible assets because a large chunk of their assets is in the form of intellectual property rights or intangible assets. And valuing those intangible assets is again a different task. So startups are basically not feasible for this because there is no tangible asset, as most of investment is in, so you don't have any tangible asset, and most of the investment is in what you say as intellectual properties. And intangible assets. Right. So that's the non-feasibility of asset-based approach. Third is market-based approach. So market-based approach are basically, why can't we use the market-based? Because there's no historical data. There's no comparable company which you may find, right? So new age startups are disruptors. They generally function in a market without any established competitors. So this competition from startup work in the same genre, the lack of established competition in the market, right? So this is like non-availability of similar company in market. So non-availability of similar companies in the market will lead to failure of this market-based approach. Okay. So then the question arises, sir, how do we derive the value of a startup, right? So every startup is going to be different, but the value derivation comes from certain basic elements which a startup has got. From where would a startup arrive its value, right? So drivers for startup, value drivers value drivers for startup would be like, we would be looking at one thing, which is product, management, right? So product management, then we have something called as traction. Revenue could be one of the drivers. Industry, what sort of industry is they looking at? Then the other value driver would be like the demand supply gap. Competitiveness. Management, traction, revenue, industry, demand supply, and competitiveness. So product. Value of the startup most often depends on the product or services which the company is into. If the idea or if the product is, really relevant, it seems to be like, promising that in upcoming future, future, this type of product or service is going to be widely used by the people, then you say that, okay, that startup has got some valuation, right? So when you had like Zomato or Swiggy in the startup phase, you would obviously mean that these entities were actually doing some business which made sense to the new age customers. Because since most of the people are now working, both family members are working, so they would generally prefer to order from outside. So online food ordering was growing at a very faster pace because that was something, which was giving convenience and comfort to the customers. Right. So that uniqueness of the product or service will definitely add value to the startup. So if the startup is something, that going to solve certain problem, that is where your product or your startup success lies on. Right. Second is the management. So most of the like unicorns you'll find, you understand unicorn. Unicorn is basically a company which has got a very high valuation. So those are mostly managed by the founders who are coming from, IITs or IIMs, like, so any startup which has got a management with, good degree of a good amount of educated directors or educated founders or founders who are coming from, from a background which has got that business acumen, they will generally find this startups to be having a greater valuation. Third is the traction. Traction is a product that, traction is basically, it's a proof or sort of an evidence that your product or business is working and there's a demand for it, right? So if any product or any startup is having that traction, that continuous demand is coming about of your product, then that startup is going to provide you good value. One is the revenue. So if there are like more revenue streams, so the company has clearly spelled out what are the revenue streams that the company is having, like maybe subscription, maybe by way of, by subscription, or maybe by way of uh, regular fees or sale of goods or services. Then more the revenue sources you have, higher would be the valuation of your startup. Next is the industry attractiveness. So industry attractiveness is definitely going to play a vital role in the value of a company. So as good as the idea may be, to sustainably scale various factors like logistics, distribution pattern, right? So these are industry attractiveness. Like for example, a new age startup in tourism industry is likely to be less valuable or unique as their offer is significant. Lockdowns are expected in future. So if you're thinking that, you're into the tourism industry and you want to get the valuation done, and if the macroeconomic scenario is not in your favor, then your valuation may not be that great. Right? So that's your demand supply, which will play an important role. So demand supply is like what is the demand from the investor and which all companies are having that uh, role, or which all companies are in the supply section. Competitiveness. The lesser the competitors, the more valuable startup will be. Okay, so when you have that competitiveness, the lesser the degree of competition, more valuable the startup will be. And there is no escaping the first mover advantage in an industry. So you obviously have that first mover advantage. If you're coming up with a new idea and you are the first one to improve it, get that first mover's advantage. Right. So these are some of the value uh, drivers or certain aspects which are going to derive the value of your startup. Right. So these startups, these value drivers are simply subjective, and hence there's a need to provide some sort of standard method by which we'll be able to derive the value. So there are many different innovative methods to value the startups that try to reduce the subjectivity in the valuation of startups that have come in the recent times. So let us look at some of the methods for valuing the startups. So first one is something called as Berkus approach. Something called as Berkus approach. So this is done by an angel investor called as Dave Berkus from the US. So he looks into valuing startup based on a detailed assessment of 5 key success factors. The 5 key success factors. What are those key success factors? First is the basic value. Right? Second is the technology. Third is the execution. Is strategic relations in core market. And fifth is and sales. So these are like 4, I can say 5 key success factors which have been undertaken. So under this approach, you will simply see what is the basic value which the business is creating, what sort of technology sophistication is there, how you are getting executed, the ideas, how are the ideas getting executed, and then what are the strategic relations in the core market, and also how much is the production and sales values. Right. So detailed assessment is carried out regarding each of these 5 success factors in quantitative measures, and then they add up the total value of the enterprise. So basic value, value addition due to technology, value addition due to better execution skills, value addition due to strategic relations that you have in the core market, and production and the sales activity. Okay. Next approach is cost to duplicate. Right. So cost to duplicate approach. So cost to duplicate approach is involves taking into account all the costs and expenses which is associated with the startup and its product development, including the purchase of physical assets. So you will be like, if I want to set up a startup similar to what these guys have, how much money should I be putting in? So this particular approach is criticized for not focusing on future, rather looking at what has happened in the past. Right. So cost to duplicate is all costs to create a similar startup. Okay. Then next is something more sensible, which is called as comparable transactions method. So under this method, you can simply look at how were similar startups valued earlier. Right. So maybe I want to value, let's say, a new business. So similar business had it been in the market for some time, then you look into the valuation. For example, if I want to undertake value of let's say a delivery, we can say courier business, you will look into like what was the logistics startup or a courier business doing earlier. So revenue of existing logistic business. This was, let's say, 1,000, and this was offered a valuation of maybe 20,000. So if our logistic business is having a revenue of, let's say, 500, you will simply say that this is going to be multiplied by 500 and then divided by this. Right? So that's going to be simply 10,000. So revenue of existing logistic business you can use as a multiple and then use it multiplier for comparable company. So this again assumes that a similar company is available in the market. Okay. Then we have something called as a scorecard valuation method. Scorecard valuation method, you will put up a score or percentages for assigning the value. So first we find the average pre-money value. Pre-money is like before you have got funding from someone, what was your value? Then we consider how the business stacks up according to the following qualities. The following qualities will be like what? Strength of the team, size of the market, product or service, competitive environment. Basically, you will just look into these aspects. Right. So scorecard is like score based on value drivers. Right. Then you may also create first Chicago method. First Chicago method, you will have like worst case scenario. You will have normal case scenario and best case scenario. Right. So we'll have like 3 possible situations that if everything is going good, then what's the best value that we can come up. If it's in the normal case, then what's the value? Then worst case, what's the value? Then you simply assign the probabilities and arrive at the value. Okay. Then there is another called as venture capital method. So these method, venture capital method, it has made venture capital firms have actually made it famous. So such investors generally seek a return equal to some multiple of their initial investment. Like whatever money initially you're going to put into the business, you want maybe 3 times of that or 4 times of that. Right. So that is where you're going to use this method. Right? So these new age startups are disruptors in their own right and necessary tool for global innovation progress is required. So venture capital use this simple method that if I'm putting in, let's say, 10 million into a company, I want 3x of that. So the valuation would be at the end of 3 years, maybe 30 million. Right. So traditional methods are failing, and even these methods are not foolproof, and it further requires more and more investigation. Okay. And when we're talking of these startups, generally valuation when we are doing for digital platform. Businesses or digital platforms when we are doing, we are going to obviously arrive at it value, right, based on different type of businesses that it does. So if we have to obtain a value of, let's say, a marketplace, right? So where you are going to match your buyers and sellers, right? Right. So marketplace, you may have a marketplace. Second, it could be like a search engine, right? Or you may have repository. A repository would be like, deposit into type of, like, for example, you take a YouTube or Spotify where you have the storage of the digital content. Then maybe digital communication, right? The communication will involve companies like WhatsApp, Telegram, right? Microsoft, all these are into the communication category. Then you may have also community-based platform like your Facebook or Instagram, right? then payment platform. Right? These are the various ways on which the valuation or the various types of digital platform. The principles of valuation of digital platform likely like other companies, but generally you say marketplace companies may be valued based on the customer search. Repository may be valued based on the subscribers that it has. Right? So these companies are of course going to have a different method altogether. And to value for that, we have multiple methods, right? So one is, of course, the income-based approach. Right? So income approach. So in this income approach, you undertake valuation by laying more emphasis on the projected financial performance, which takes into account what will be your future revenue, future costs, and backward working is carried out in the form of top-down, or maybe you can even take the bottom-up approach. The top-down approach is where you are going to look at what is going to be your sales and then come down to your final profit, right? So backward working is required under top-down, which basically starts with analysis of total potential that the market has to offer you. This is always a total addressable market. So first you do something called as TAM, which is total addressable market. And then you will say serviceable addressable market. And then you will say service obtainable market. The company needs to estimate its business based on how much portion of market it can serve. And so the company needs to estimate its business plan to accomplish its objectives. This would involve, of course, needs for what are your future business plan. The financial forecast should take into consideration the types and features of business model. A digital repository which allows, let's say, streaming of content. Then in that case, if it is looking for streaming of the content, may earn revenue based on subscribers, while the payment solution may be on the basis of number of transactions that it does and based on the commission that it gets from the receiver of the money. Right. So top-down approach can be ambitious for a company at a nascent stage, and as estimating market size and market share poses bit critical challenge. Understanding how much the market size is going to be, out of that, how much we are going to acquire, that's a typical task. So you can also use a bottom-up approach. So young platform can, a new platform can actually estimate its revenue and cost given its financial constraint. Promoters of such companies can use this bottom-up approach by simply forecasting what revenue you are looking to earn. Of course, to discount rate that you use is the KE, using the CAPM model. You can also use the market-based approach, right? Now, for these digital valuation, the digital platform, the value drivers that we can say, marketplace, which is matching the demand and supply. The value may be dependent on, let's say, value drivers. It would be like number of booking made and number of registered users, or volume of transaction. Right? So depending on the number of bookings, number of registered users, volume of transactions that you are making, that's your marketplace. Second thing is, if you have like a search engine, it could be, again, number of users. How many users are using the search engine? A repository where you are having the content of content storage. You will look into like quantity of data, and also you will look at what sort of quality are you offering. Right. So any repository where the files are stored, where the data is shared, that will be well evaluated on the basis of quantity and quality of data. Communication, which is network for messaging, right? So there will be like, again, number of users, the number of users, maybe subscription fees and all such as communication. Maybe then also communication would be, advertising would be also one of the value drivers. Community will be again same, the number of users, how many do we have, subscription fees that we are charging. And payment place is like, number of active users. Okay, so these are some of the value drivers that we can think from the point of view of digital platforms. Okay. Then when we're looking at valuation of professional or consultancy firm, there the professional firms can be defined, providing customized knowledge-based services. Like any other business valuation, understanding the present and the projected industry trends plays a significant role in determining the accurate value. So these companies have got certain key performance indicators. So while historical data is important, projected growth is also going to impact the overall value. Although valuation is undertaking taking into account the future potential, estimating that is very, very difficult task. So one commonly used method to value these professional firms are by when a firm meets the expectation comparison of current industry benchmark. So you look at the key performance indicators of the companies. Okay. Then there is something called as a term ESG. ESG stands for environmental,
Excuse me, sir.
social, yeah.
Can you please again say the full form of SOM you have used in income-based approach?
TAM is the total addressable market.
Yes.
Right? Total addressable market is basically how much total marketplace is available to that. Now, out of that, how much market can you service? I mean, how many people are ready to buy your goods or services? And SOM is what is your serviceable obtainable market? Out of this serviceable market, how much you can obtain?
Yes, sir. Clear.
Total addressable market, serviceable addressable market, and serviceable obtainable market.
Okay, sir. Thank you, sir.
Okay. Yeah. Now, this is, ESG is something that's a fab nowadays where investors are putting more value to the companies who are complying with ESG norms. Now, when I say ESG norms, you need to comply with your environmental norms. Social means looking into the social aspects and also the governance. So what all things are included in each one of them? Let's have a look at it one by one. So environmental, and governance. So environmental, social and government, it's like climate change. Right? So there is a climate change that is happening. If your business is addressing these aspects by one or the other way, then you can assume that your business is likely to get a higher valuation. Water conservation, right? Waste management, then fulfilling the emission norms and encouraging the biodiversity. Social areas, you can say employment generation, employment development, or you look into the diversity and inclusion. Like in some of the companies, they're very much socially active, and they generally look into how diverse their workplace is, right? Work from people from various religion, various caste, various creed, and those are something which we are going to publish, and that adds like additional value. Then what you're doing for community development. Then you have something called as health and safety, and also how you are more sensible towards your customer requirement, right? Then looking into the governance aspect, into the independence of board of directors. Ideally, the board of directors should be independent, right? They should be taking decisions for the benefit of the company and the shareholders and not for the personal benefit. Then we also look at what is the diversity in the board, right? Uh, Tax transparency, right? Then we have like ethical conduct, right? So these are the three areas where we are looking for the ESG things. So ESG is on the radar of several investors nowadays. Focusing on ESG issues can actually bring out risk and opportunities which a company has got. So the key environmental aspect which are under consideration are, climate and the natural scarcity, right? So tremendous momentum has been done in this ESG plan, and very key development has come up. Like there are dedicated funds who are investing into ESG. There's a sustainability of taxonomy which is on rise. Convergence with the ESG framework. SEBI is also proposing a regulatory framework for ESG disclosures by the listed entities. That is not yet come formally, but yes, it's very soon going to come up. So ESG, it could be one target. Many companies actually come up with these things where they say that we are targeting to become a carbon neutral. Carbon neutral means whatever carbon emissions we are doing, that will be, absorbed back by us in certain areas by plantation activities, right? So socially working CSR activities, and G is basically the governance, how compliant you are with respect to the laws and regulations of the country. Right? These are some of the ESG aspects that we have in the valuation part. Now let me just do one thing. Let me just take maybe question. TP, so that we'll be able to discuss that right now. Time. Let's do one question because conceptually we have done everything. But now let me just take up. We have like security valuation or business valuation. Have any? Okay. Final question. one aspect that we have for, well, we done everything, yeah. We've covered everything. Just one more question I would like to take up. Yeah, I want to discuss, let's say, about the valuation concept through the case studies. Let's say the recent merger that was in news, that was about Vodafone and Idea, something like that. Okay, there is one thing which was left out, which is called as the chop shop of. Now, this particular method of chop shop is applies to used companies. So this is used to value companies which are this chop shop method is simply used to value companies which have got multiple businesses. So value companies which are conglomerates. When I say conglomerates, it means into multiple businesses, right? So this is used to value the companies which are conglomerates or which are into the multiple businesses, right? So for example, if we have companies which are, we have information about sales, we have information about assets, and say we have information about income or the profits. Okay, so there are three divisions. The companies into business line of business are three separate businesses. So let's say one is into online food delivery. The other is maybe into instant goods delivery, right? And also maybe into cab services, right? So these are the three areas which your business is. Of course, all these three businesses are unrelated to each other, right? Sales are, let's say, 23,000, 43,000. Then we have 35,000. Assets are, suppose, 30,000, 35,000. And this is, let's say, 15,000. Income or revenue or profit which that is being generated is, suppose it is 7,000, 12,000, and it is, let's say, 20,000. So there are three divisions which we have, and the three divisions have got these financial numbers, which are the sales, the value of assets, and also the income. Now, when we look at similar businesses in the market, we find that there are certain capitalization numbers, right? So multiples are available with regards to these type of businesses. So multiples that we have for each one of them, right? So sales multiple is, let's say, it is 0.6. Like we find that the value of similar companies are 60% of their sales, And same way you can look at asset multiple. So asset multiple is, let's say 1.1. So whatever is the value of asset, the value of business is 1.1 times of it. And we may also have the income multiple. So income multiple is, say 0.7. So 70%. 70% not matter. 7. So whatever is the income, the value is 7 times of it. In the instant food delivery, the same numbers are like 0.5, 1.2, and it is 8. And for cab services, the sales multiple are like 2, asset multiple is 3, and income multiple is 5 times. So we can actually arrive at the value of each one of these businesses under the multiples approach, right? So we can say value of online food delivery. Value of online food delivery, we can say it is 23,000. I mean, there are based on different approach. So based on sales multiple, then this is based on assets multiple, and then this is based on income. Value of this online food delivery would be like 23,000. You simply multiply it by 0.6. So value should be like 13,800. And asset multiple for similar companies, since it is 1.1, we can say it's 30,000 into 1.1. Then based on income, you can say it is 7,000 into 7. So there are 3 different values which are arrived at. We can obviously take a average of all of them, right? We can take a average of all the 3 methods, that we have done, which is a online food delivery. I mean, based on the sales multiple, then based on the income multiple, and based on asset multiple. We can use them and simply take a average of it, right, to arrive at their respective value, theoretical value. So value of this food delivery business would be, for that purpose, we'll take the total and then we'll take the average. So the total is simply going to be the sum of this 95,800, and average would be like this divided by 3. So this business online food delivery valued separately. It will be valued separately by chop shop method. Under this chop shop method, you're going to value each business separately, and then you're going to club all the businesses together. So if I want to get the value of instant goods delivery, then this is going to be the sales multiplied by the instant good delivery number, the multiple, right? So we apply the same numbers here. And then if you look at the total valuation on the similar lines, it will be 1,59,500, right? Average will work somewhere like 53,166.67. Same way, I would like to value the cab service. Cab service will be like 35,000 into the cab service value, which is the multiple, sales multiple. So we arrive at this multiple, take the total, and then simply arrive at the value. So under chop shop method, we calculated the value of each of the businesses separately. So we obtained the value of each business separately, and then we added all together to arrive at the total value of the company. The value of the company is arrived in this way, which is by using this chop shop method. Is this method clear? The chop shop approach? Yeah. Pretty simple in easy method. So this is, remember, this method will be used only if you are into multiple businesses, right? So only if you are into the multiple businesses which are into different or which are conglomerate which are not related to each other. Otherwise, we'll have to take the value of synergy also. Okay. So this is what the chop shop method that was last pending from this part. So I think we are done with this chapter with all the concepts and questions also. So if you have any queries, you can raise them. So any queries, you can just feel free to raise it right now.
Okay, students. I think there are no more queries. Thank you for your patient listening, and thank you, Jagbandu sir, for enlightening the student on this concept of business valuation. Now, this topic is important because our next topic is merger acquisition, where it is a more relevant because when merger acquisition takes place, it is the basis of valuation on which the swap ratio and other factors are decided. And recently there are news like Jubilant is taking over the Coca-Cola. So if you read any financial newspaper, so every day I think is there I don't think any day or any in any week you will not find any the news of any merger acquisition. So of course, for merger acquisition, valuation forms the basis. So with this, we come to the end of the this business valuation topic, and we will start in the next class merger acquisition and corporate restructuring. Student, since you are associated with our live classes for a long time, so my request to you for our own records, you can share, please share your registration number only. So you can privately chat me at this, you can send this through chat. You can at C Ashish Gupta, just share your registration number along with your name. Or if you can send me, share your registration number at my email ID. Jagbandu sir, just show the student. This is my email ID. Or this is my phone number. If you have any query related, you can ask me, or you can send your query at this number. Or you can also send your registration number along with your name at this. Otherwise, you can share this share number through private chat here only. So student, with this, we come to the end of the session. Please start sharing your registration number so that I can note it down. Thank you. Have a nice day and see you in the next class. Just start sharing. We are opening, keep opening this session. Mhm. नहीं अशोक जी just Pooja, you just talk to me separately for the same. Okay, I will let you know. Okay,
Okay, sir.
okay, just. सेशन ओवर कर दो। कोई और चैट आई है? बट ठीक है, इनकी पिक ही ले लेते हैं ना, तो एक बार फटाफट देख लेते हैं, पिक ले लेते हैं, डाउट भी नहीं आ रहा है ना। दिखाओ, और दिखाओ, नीचे दिखाओ।
Excuse me, sir.
यस यस,
Sir,
यस यस।
सर रजिस्ट्रेशन नंबर के साथ में नेम वगैरह भी सेंड करना है?
निजा हाँ, नेम आपने आपके उसमें मैसेज में आ रहा है?
यस सर।
क्लियर, नो प्रॉब्लम, नो प्रॉब्लम। थैंक यू,
ओके, थैंक यू सर।
थैंक यू बेटा। ओके, ठीक है,
अशोक जी,
एंड द सेशन।